Okay, so the business cycles. So guys, this is going to be the transaction flow. How the client records the transactions that land up in the financial statements with the help of the control activities. So everything we've just looked at, those control activities are there to ensure that this transaction gets recorded in the financials correctly. We've got revenue, purchases, payroll, inventory, and finance and investment cycle. And we've already looked at the legend back in the slides, guys. This is what we're going to be using when we are putting down where each of the controls need to be. Pre-numbered documents, I'm going to put a little hash sign. Reconciliation, I'm going to have the arrow reconciling the two items. Access controls, where there needs to be, I'll put an A. Authorization, a circle, and down arrow for segregation of duties. As you're going to see, we're going to put the documents down, and every time we move on to a document, we're going to have this downward arrow, which means there needs to be segregation of duties every single time. Okay, so starting with revenue, guys, use your whole A4 page to put down these documents so that you can easily follow how revenue originates until it lands in the financials. The first document is going to be the external sales order. This is the document that we get from the customer requesting whatever it is that this business does to generate revenue. Guys, if you're not going to remember ESO, then actually write down external sales order, because otherwise you're going to forget and question what was this supposed to be. Then, if we are selling on credit, which we assume, if it is a new customer, there has to be a process to authorize this as a new customer. If it is an existing customer, to ensure that we can sell to them. So for a new customer, there must be a credit application form. For an existing customer, the credit limit must be checked to ensure that they do not exceed this limit. Then an internal sales order will be generated as the internal document, and a price list must be used to ensure that the pricing is correct. From there, a picking slip will be generated to pick the goods, followed by a delivery note to deliver the goods. An invoice is then generated, and as soon as the invoice is generated, the sales journal is created. Okay, a debtor statement then follows to be sent to the debtor. The debtor will then send a remittance advice or remittance note that's going to explain what they're paying. And finally, a receipt with the cash receipts journal being recorded. And then only if there are any returns, there would be a credit note followed by the sales journal reversal of the revenue initially recorded. And that's the revenue cycle. Now we need to go and assign the controls throughout the cycle. So first control, that's easy, segregation of duties. I've already said every time you see that black arrow, we know there must be segregation of duties. So there must be someone else doing the work from the person who did the work previously. And guys, that ultimately means you need to have a huge staff contingent for these cycles, because credit department must be different from the internal sales department, from the picking, from the delivering, from the invoicing, and so on. Next control, pre-numbering of documents. So the credit application form must be pre-numbered. The internal sales order must be pre-numbered. The picking slip must be pre-numbered. The delivery note pre-numbered. The invoice pre-numbered. The debtor statement is a statement. The remittance advice comes from the debtor, so it's not our document. But the receipt is ours, so the receipt will need to be pre-numbered. And a credit note if we issue one. Before we carry on with controls, guys, I should have actually discussed what is going to be on each of these documents so that you understand. External sales order comes from the customer with the quantity of the goods that they want. The credit application form is then completed, and we set a credit limit for the new customer as well as any other credit terms. and the credit limit for existing customers will have the rand value for which they can purchase on credit. The internal sales order will have the quantity and the price, which will come from the price list. The picking slip will have the quantity of the goods that have been picked. The delivery note will have the quantity of the goods delivered, which could differ. For instance, if they're loading and they notice an item picked as damaged, they're not going to load it, and so the quantity will differ. The invoice is going to have the quantity and the price, and this is what is going to be given to the customer stating they owe for the goods delivered. The debtor statement is going to show all of the invoices that are owed by the customer or outstanding, and the remittance advice is going to come from the customer stating the invoices that they are going to settle in this payment. And these two could differ because they might have invoices with extended terms which they are not going to pay for immediately. The receipts will have the rand amount that was received, and your credit notes will have the quantity and the price of the items that have been returned. So let's look at reconciliation now as a control. Everything should be reconciled to its previous document. So our internal sales order should be reconciled to the external sales order in terms of description and quantity. Our picking slip should be reconciled to the internal sales order in terms of quantity, and delivery note to the picking slip. The invoice, a quantity should be reconciled back to the delivery note, and price to the price list. The debtor statement, all invoices should be checked to the actual invoices owed. The remittance advice should be checked to the debtor statement to make sure that all invoices that should be paid are being settled at each payment. Receipts to the remittance advice, making sure that we are receiving what they're actually stating they are paying. And then finally, if there are any returns, the credit note should be reconciled to the delivery note. The quantity that is being returned should be reconciled to the delivery note, because they shouldn't have accepted those goods and made the notes on the delivery note for that. Our next control, access controls. To any of the unused documents within the cycle, there must restricted access to those, so fictitious documents are not created. In terms of our physical assets, there needs to be access controls around the picking area and the delivering area, because that's where they've got physical assets available to be stolen. So around the picking slip area, where they pick the items, they need to have security so that people can't just pick and steal and get away with it. And around the delivering, there needs to be gate control. So as the items are leaving the area, the gate staff need to check that the items in the van match to what's on the delivery notes. Okay, where does authorization appear? Around the credit application form, around the credit limits, around setting any credit terms for new customers. The internal sales order needs to be authorized by the sales manager, and the price list must be authorized by the business. The delivery note must be authorized by the customer, who actually signs acknowledging accepting the goods. Any items they don't accept, they make a note on the delivery note so that they don't get invoiced or a credit note is generated for that. The invoice needs to be authorized. And then, like we said, if there are any returns and a credit note needs to be generated, that must be authorized. And that is your revenue cycle with all of the key controls being included. Let's just quickly take a look at that legend. We have got pre-numbered documents, reconciliation, access controls, authorization, and segregation of duties throughout that cycle. Therefore, they should minimize the risks of misstatements from the initiation of the revenue all the way through to the recording in the financials. Let's do the purchases cycle next.